But when it comes to gold, gold has gone sideways for 13 years. This is not 2011. We're nowhere near top. This is like 2001 when gold finally broke out of a 20-year bear market. I also said that eventually the Fed would end up going back to QE to try to get those bond yields to go down, because I knew that the rate cuts alone wouldn't be enough because they were inflationary and they were bearish for bonds. So if the Fed really wants bonds to go down, it's going to have to buy the bonds itself. But of course, first it has to stop selling bonds, because that's what it's doing now. It's selling bonds. And a lot of other people are selling long-term bonds. You'd have to have your head examined to want to buy a long-term U.S. Treasury, even at 4.2%. Inflation is going to be well in excess of that. That's what the gold market is saying, loud and clear, except nobody is paying attention, at least, in the mainstream, because inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling, because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do if you understood the predicament that the U.S. economy is in, and if you understand basic economics and finance, which, of course, nobody does if you're in the mainstream financial media. And most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. And you're not seeing any, blowout move in the mining stocks. Yes, finally, we have new 52-week highs, multi-year highs in the GDX and the GDXJ. The next key resistance is to really take out the 2020 COVID high. Even though gold itself and now silver, both metals are higher than they were in early 2020. Neither of the gold stock indexes, or there's more than two, but none of the gold stock indexes have taken out their highs yet from early 2020. That's coming up. That may happen this week. And then I think it's off to the races. By the way, I wanted to point out, as everybody is talking about how, the economy is stronger than expected, the only economic data points that have come out so far this week, Richmond Fed manufacturing came out today, minus 14, bad number. Yes, not as bad as the minus 21 from the prior month, but it's another minus, another negative number. And it just continues this manufacturing recession. But also, I thought what was significant is we got the leading economic indicators for September, another negative, minus 0.5, which was bigger than the downwardly revised minus 0.3 from August. It was originally reported as minus 0.2, but they revised it and made it worse. And minus 0.5 was worse than the lower end of expectations. They were looking for anywhere from plus 0.1 to minus 0.3. But what's really significant is Joe Biden has been president and Kamala Harris has been vice president for 45 months. And during those 45 months, we've only had 6 months out of 45 where leading economic indicators were positive. And I think 4 of those 6 happened like in the first couple of years, right? So in the last 2 years, we've had 2? But 6 out of 45, that's 13% of the months have had a positive number. I don't think that's ever happened. I mean, I'm confident that's never happened over a 45-month period. That in any, ever since they started keeping track of these indicators. So how can we have such a great economy if the leading economic indicators have been flashing, recession for 87% of the months that Biden and Harris have been in office. So the idea that bonds are rising because the economy is strong, no. And in fact, I heard more people again say that, well, the strong economy means more inflation. And so that's also pushing up bonds. No, a strong economy would normally mean lower inflation because the strong economy would produce more, which would keep a lid on prices. It's weak economies that result in more inflation because they result in more stimulus. They result in more money printing. Government revenues go down, their expenditures go up, they have bigger deficits, they print more money. So weak economies are historically far more inflationary than strong economies. That's what's going on. It's not about a strong economy. It's about strong inflation and a huge supply of bonds for which there are few buyers. All the talk, though, of a stronger economy driving bond yields higher and causing the Fed maybe to cut slower than the markets had anticipated has caused some buying in the dollar, which bounced off. It was down around almost ready to break through 100. And now it's back above 104. So we've had a 4% rise in the dollar. It's been strong across the board against other currencies as it's been weakening against gold. But the fact that the dollar has gone up by 4% and gold has also gone up means that in terms of other currencies like the euro, the pound, the yen, the Aussie dollar, the price of gold has gone up even more than it has in US dollars, which is actually even more bullish for these mining companies because most of their costs are in Canadian dollars or Australian dollars or South African rand. So the profits of these companies are rising even more because in terms of their cost structure, gold prices are rising even higher than they are in dollars. But I think this is just a short-term phenomenon. I still expect the dollar to roll over and break below 100 and go significantly lower than that. And then we came back down. But it's interesting. I'm watching on CNBC on Monday morning when gold is, gapping up to a new record high and silver's up. And not only did they not mention gold at all or silver on Squawk Box, but they did mention Bitcoin. They said, oh, look, Bitcoin's at a 6-month high. Big deal. Gold was at an all-time record high, yet it wasn't even worthy of a mention, yet they pointed out that Bitcoin made a 6-month high. Big deal. So what? It hasn't done anything. 6-month high. There was a significant event going on in a significant monetary metal, yet they only focused on an insignificant event happening in nothing, in a digital token. And I was also watching, was it the next day, they were talking about, they had a guest come on. Maybe it was the same day, but this guest came on and he started talking about the melt up in the stock market and how like the stock market's just going to keep going up. It's going to melt up and you just got to buy, stocks are going to go up. But they ignored the fact that the market was actually melting down if you price it in gold, that the stock market was down that day and it was down this year. If you measure it in real money. Now, I actually agree with what this guy is saying in that, yes, the stock market will likely keep rising in dollar terms because inflation is going to be so rampant. Yes, prices are going to go up. That includes the price of stocks. But the price of groceries are going to go up more, right? The supermarket is going to see better returns than the stock market. That's why people should, load up on food, because the food that you store will probably beat a lot of the stocks. But that's what gold is telling you. It's a meltdown that's being disguised by inflation. Again, that's one of the reasons that politicians like inflation, because people feel like they're richer, right? Their stock portfolios are going up. They're getting a raise, right? And so they think things are good because the numbers are bigger. But it's all an illusion, right? They're actually getting poorer while they think they're getting richer. This is what the politicians want. The politicians want voters to think that they're better off, so they'll reelect their leaders, right? They don't want to be honest and say, yeah, things are lousy, because then it's okay, well, we need to vote for somebody else. So they create inflation, and one of the extra benefits of the inflation they create is that it creates this illusion because of these bigger numbers. Now, when gold hit 1900 in 2011, right? It started this big run because it was at under 300 in 2001. So it was a huge move. And early on in that move, I put out this post on X because I had remembered, because CNBC was like not giving a damn about the price of gold because they weren't even talking about it. And so I posted this clip that it's like a minute and a half clip, but I went on Squawk Box back in the day when I was a regular, and they nicknamed me Dr. Doom because I was forecasting this financial crisis. And I'm on with Mark Haynes, and gold is $495 an ounce. It's actually down that day, but it's $495. And I say, the last time I was in your studio, because most times I did the things remotely, but I said, last time I was in your studio, gold was $60 an ounce lower. This is a big move. That's a big loss of purchasing power. And Mark Haynes is like, who cares? Why should I care about the price of gold? What difference does it make, right? It's meaningless, right? Well, they didn't care about gold when it was $495 an ounce. And now that it's $2,750 an ounce, they still don't care about it because they have no idea what it means. Or if they do, they certainly don't want their audience to figure it out. But when gold got to 1900 in 2011, right, it was a big move. And gold didn't have any real big pullbacks then either, except for 08. When we had the financial crisis, we had almost a 30% decline. Gold went from about 1,000 to 700 and change. But when the Fed showed its hand and announced QE, gold took off. And because initially people, not just me, I wasn't the only one. There was a chorus of people who were saying, this is terrible, right? There's going to be massive inflation. You got to buy gold. QE is going to be a disaster. The Fed is making a mistake. Now, all those people were right. But so gold took off because of those initial concerns. But after gold kind of peaked out and there was some profit taken, all of a sudden, investors got convinced that the Fed pulled off a miracle. And there wasn't going to be inflation, that we were able to print all this money and do all this quantitative easing, but there wasn't going to be any inflation. So all the guys like me who were warning about inflation, we were all wrong. I remember Paul Krugman called me out by name back then and took a victory lap. Peter Schiff was wrong. He was warning that QE was going to cause inflation, and see, we have no inflation. Well, first of all, I never said that QE would cause inflation. I said QE was inflation. And there's a big difference between the two because we had inflation. It just didn't show up in the consumer price index. Now, one reason was because the consumer price index is designed to hide the price increases. So we actually had a much bigger impact on the CPI, but the numbers weren't honest. But of course, a lot of the inflation in the early days of QE went into stock prices, went into real estate prices, went into bond prices. So asset prices were being pushed up by inflation, but nobody cared about that. Everybody was happy about that. But I knew all along, and I was telling my audience, that all this inflation would eventually come home to the consumer goods. That regardless of how the inflation entered the economy, it always ends up in the same place. Because everybody who's buying assets eventually wants to buy stuff. I mean, that's why people buy stocks, so they can buy more stuff. Owning stocks are a means to an end. You're trying to get wealthier. You're trying to accumulate more money. Why? So you can buy more stuff. And so everybody wants to turn their paper wealth into consumer goods, whether it's buying a new house, buying a car, taking a vacation, buying new clothes, entertainment, whatever it is. People want to spend money. And so I knew ultimately that's the final resting place. All this QE, all the money that was printed, eventually it's showing up, in consumer prices. And that finally happened in a big way in 2021, 2022. It's finally here. Paul Krugman was wrong. I was right back then. QE was inflation, and now we are having to suffer the consequences of all that inflation. But when it comes to gold, gold has gone sideways for 13 years. This is not 2011. We're nowhere near top. This is like 2001 when gold finally broke out of a 20-year bear market. We went sideways for 13 years. And during that 13 years of sideways action, that's where Bitcoin came, because Bitcoin and all the Bitcoin pumpers were able to say, look at gold's gone nowhere. We've printed all this money. We've done all this QE and gold hasn't gone anywhere. Well, that's because gold already went up. It already went up from 270 to 1900. And then it went sideways. But that didn't mean it wasn't going to have another leg up. Now it's happening. Now it's just starting. And gold has a long way to go to catch up to where it needs to be based on how much money has been printed over those 13 years. Now, some of it was already factored in early on, but the people who were worried about QE1 and QE2, they had no idea what was coming with QE4 with COVID or what's about to come now, after this election.